is a recent article on Fox Business. So the first 8 months of the year mark the lowest turnover rate in at least 30 years, according to Redfin, which conducted an analysis of housing turnover by comparing the first 8 months of 2024 across different metro areas, homes, and neighborhood types. It is using turnover as a way to measure the housing availability. Comparatively, there were 37% fewer homes sold this year compared with during the middle of the COVID-19 pandemic's buying frenzy. In 2021, 40 of every 1,000 homes changed hands. There were also 31% fewer homes sold compared with 2019. So that's the reference data show. Mm-hmm. So with the interest rate coming down, should you buy a home now or not? Is this a buyer market or seller market? Well, I mean, with our experience right now in the greater Boston area, the suburb market's hot, right? The single family homes, the townhomes, it goes. The condo market in the city, it's cold. Like it's just not moving. Mm-hmm. So from your perspective, should the buyers pull the trigger and buy?
Well, it's a great question, and of course, it's going to be individualized. That is to say, that's why the importance of needs analysis comes into play. So, if a buyer is living in a 2-bedroom home and they've got 5 occupants or 6 occupants, and they're stretched for space and so forth, and they have needs that require more space, then to some degree that's going to be the driving decision maker. Now, obviously, we're going to look at what's available, what the price is, cost, and so forth. But it really comes down to the needs first. Now, in terms of the market itself, I always say that there are really 5 factors that determine whether we're in a buyer or seller market. And those 5 factors have to be leaning toward either the buyer or the seller for it to be a seller market or a buyer market. Otherwise, it's kind of a mixed market. Now, based upon that Redfin information and the information that we pull monthly to judge where the market's headed, we know that transactions in the last few months have been lower. Decline. So that would be an advantage to the
buyer.
Right? Mm-hmm. Notice I didn't say, that makes it a buyer market. One factor, these are 5 silos, 5 silos, and so they've all got to be pointing in the same direction. So transaction sides are down recently, so that points to the buyer, advantage buyer. Prices overall continue to drop. So again, that looks like an advantage to buyers. The third thing is market inventory. Market inventory has now a trend of going up. Okay, so who does that advantage? Also buyers.
So 3 already.
So now we're climbing, right? We've got 3 factors. The 4th factor is the interest rate, the mortgage interest rate. So where is that? Is that an advantage? Because it's coming down now, but in relationship to prior to 2022, it still is perceived as being high. Mm-hmm. So that's a little bit of a mixed factor. And then the last one is the affordability index. And so
we're going to get into that later.
Oh, okay. All right. I don't want to jump the gun then.
Right. No.
So how affordable, the measure of affordability. So what I would say to your question, Anson, is many of the factors are pointing to an advantage to the buyer. just like any other market, you hear this all the time in talks about the stock market. It's really hard to time the market, to buy at the very lowest point, because you don't know that you've hit the bottom until you're off the bottom.
Right. Yes.
Right? Oh, there's the bottom, because we're off the bottom now. And the same thing with the peak. We don't know if we're at the peak until we're off the peak, right? So it's very hard to time the market. And that's why it's that combination of factors that we look at of those 5 and see where the advantage is, and then match that with the consumer needs. So my answer would be, if you're pushed for space or convenience, and when I say push for space, it isn't always, I've got a growing family, so I need more space. There's also being pushed for space. I'm going to admit it. I did it this year. We were pushed for space. We had a 5-bedroom home in the suburb with an acre and a half, and it was built when we had 3 kids. We still have the kids. They're still on the payroll. No, we still have the kids, but they're not living at the home. So now we've got a 5-bedroom. And there's 2 of us.
You don't need it.
We don't need it. We're pushed for space. Yeah. So it can go either way. The point is.
So with my experience, because I am very I would say in touch with the city market. So I think COVID really changed people's perspective of living. During COVID, because everybody have to isolate from everybody, and everybody seeing eye to eyes at home, and everybody hate each other. Everybody wanted their own personal space, right? It used to be in a home that there's one office.
Now it's 2.
Now it's 2. Both the husband and wife, one in an office.
Divorce rate even increased.
Right, the divorce rate increased, right? And
Yeah.
the kids needed a playroom, right? And then everybody needed a backyard, right? And then you have a dog. Right? Usually you can live, in an apartment with a dog. Now you want a fence, you want a yard, you want a fence yard. So it really, with my firsthand experience, it really drive people away from the city. But the more important aspect is that during COVID, a lot of people that they work remotely, they work from home, right? And all the companies, you can work from home 5 days a week. And after a couple of years, people kind of realize, I can actually work at home, right? Especially in those big firms. I no longer need to, obey the 9 to 5 rules, right? I can work anytime I want as long as I get the job done, right? Who cares if I work from 9 to 5, right? So that really drive people away from the city, especially with those big firms that have big offices in the city. And back in the day, I feel like people wanted to be as close to the office as possible, right? I want to walk a few blocks, away from my office, and that's it, right? So I think that really drive the population, the buyer demand out from the city. But do you think now is the perfect time to buy from investor perspective that, look, company are driving everybody back to the office, all the company demanding everybody to come back to the city. Do you think if we have investors that they're looking for investment opportunity, right? Let's say a condo building, 4 units, 6 units, 8 units. Do you think it's a perfect time to buy those investment condo buildings? So when obviously you just said you can't really time the market, but with all this momentum and with all this, different factors coming in, and that's what we see, that the companies, all right, January 1st, 2025, everybody have to be back in the office. Do you see that it's a perfect opportunity for investors to buy now, to buy the deep, and looking for a great return in the near future?
Well, it definitely has improved, and that possibility and of investor-owned condos, residential condos, is definitely improved because, prices have moderated. There is more inventory, and now, to your point, there probably is going to be an increased demand because people are going to have to, be in the office more. I do feel that companies are still struggling with the whole in-office thing because we know that there are reports out there that say actually workers' productivity increased by working at home.
Right.
Okay, it wasn't necessarily stuff that, to your point, that was being done between 9 and 5, but it was being done and being done a little bit at a higher rate. However, what is missing, or what I think companies are feeling, I'll just be, transparent with you, is the cultural dynamic that gets created when people are in a working environment together. That's really, and we may not really have a good handle on what impact that has or will have on a company's, I call it interior or internal culture. And we've tried to replicate it in a variety of ways, right? We have Zoom meetings, and I can remember during the pandemic, I used to host a thing on our Zoom for our agents called, the water cooler. And I mean, it was just us all standing around each in our own offices or bedrooms in front of a Zoom thing, and having soda and pretending that we're at the water cooler talking about things,
Team
we're
builds.
trying to replicate it, right? And there are just some things you can't replicate without being in the same room. So we really don't know where that's going, other than the fact that some companies have successfully put in place, you must come back, or it's 4 out of 5 days, and so forth, because of that cultural shift that people are feeling. So to that regard, Anson, I think there is an opportunity for folks who have a desire for investment to move into that sector of the market. We also, I just want to go back to something you said earlier, and that is, single-family homes seem to be doing, still pretty strong and well, but the condo market is feeling it a bit. So that's a good news for a new buyer or an investor buyer, and candidly, it's a trend that I have experienced over the course of my career of 45 years. Condos tend to adjust before single-family homes always have. And people say, well, why is that? Well, I think it has to do with the number of condos that are available, or the market inventory of condos. And we also know that with the aging of the baby boomers, condos are somewhat in higher demand because people don't need the space and want the convenience.
Downsizing.
And the turnkey. I want to go to Florida for 3 months. All I have to do in the condo that I have in New England is turn the key and, put the heat on 62, and, I don't have to worry about shoveling, blah, blah, blah. Mm-hmm. So it is an interesting thing to watch where things are going with the condo inventory versus single-family homes.
Yeah. So go ahead.
I just feel like everybody, regardless of the market, just the personal, like everybody has to go through certain patterns or phases in their lifetime. Being a student, go to college, graduate from college, and need to find a job near college. Sometimes you find a job, you have to find a rental near college. So for the investor, if you are invest in the right location, you will always get a group of tenants, because that's, even the tenants realize, the suburb has bigger space, but if they have to go to work, so everybody has to go through certain patterns and phases, and they need to rent.
No matter what.
Yeah, no matter what. I mean, 10 years down the road, you will be a house owner with kids. But when you go through your current phase, your young professionals, and you need a place to rent. Or sometimes they just go straight to the investment as a 1-bed or 2-bed condo for the convenience, because your momentum is not ready for next phase yet, and you still have this kind of market for that kind of buyer. So this works for the buyer and investor.
Definitely.
Yeah.
Definitely.
So I have 2 articles right here, and The first one is on Zillow. So in 2020, a household earning $59,000 annually could comfortably afford the monthly mortgage on a typical U.S. home, spending no more than 30% of its income with a 10% down payment. That was below the U.S. median income of about $66,000, meaning more than half of American households had the financial means to afford home ownership. Now, roughly 106,500 needed to comfortably afford a typical home is well above what a typical U.S. household earns each year, estimate at about $81,000. So that's one article. And another article on Realtor.com, until early 2020, the minimum required income for medium price home was close to medium household income. We know what a medium price home around $38,500 at the time would take a household income of about $79,000 using the Realtor.com affordability calculator. So when the mortgage interest rate were hiked in 2020, home ownership is shot out of reach for the median household income. By June 2024, the required income had climbed to about $120,000, and with the median household income trailing at around $84,000, a small affordability gap suddenly became a staggering $36,000 deficit. That means the minimum required income for medium price home is now more than 40% above the actual median incomes. So with everything's going on, and obviously, we all know that in the U.S. we shut off approximately between 6 to 7 million house shortages, right? We need housing. Housing is a big problem. But right now, in a lot of markets, there's no inventory, because we talk about we have more inventory than the past, but still a lot of people that they have a 2%, 3% mortgage that they're not willing to let go of, because comparing to what's out there, 5%, mid 5, high 5 still. So people are not willing to sell because they can't afford to move to a new home, right? So all right, I'm gonna hold on to it. So that's less inventory, no supply, but still the demand's high because we're short of housing. But you can't afford a house, you can't afford a home, so no deal is going on. So with today's inflation, the income also does not catch up. So what are your recommendation and advice to the younger generation and the first-time home buyer, like in this chaos, I would say, this very uncertain time? People can afford, like, people's income got wiped out. Like, they probably, like myself, we make some money off the stock market, like prior to 2020, but everything after that, take a dip, right? And everybody's, savings, right? Even the milk is double of what I used to pay, right? Gas price, and
They expect you to pay 20% tip for a takeout too.
Exactly, right? So with now all the savings and dried up, but people still want to take on a home ownership, right? So what are your recommendations for the first-time home buyer? I know it's hard. It's a hard topic.
When I do the rental market, people used to say, I would rather pay mortgage down payment than paying the rent. But I don't hear that anymore nowadays because the mortgage is so high.
I think it's really depends like the interest rate and the rental market, because the rental market, then they compare that like how much they pay each month and then how much they need to pay for the mortgage.
Right.
And if this makes sense, then they maybe just choose to buy.
Right.
But of course, there will be a lot of a compromise when they choose the house, because for that income, they can only afford maybe, 3 bedroom, 1 bathroom, like a tiny house, instead of like, okay, I can go like buy a $1 million house. It's hard.
Oh yeah.
It's hard.
Yeah, so it's you've portrayed, laid out kind of the critical characteristics of the market or things that people should look at. couple of things. One is, we have to really be aware too. When we talk about mortgage, let's start with mortgage rates. Probably one of the bigger factor of this affordability index shifting so significantly, and it creates a challenge on both ends. In other words, sellers are sitting there with a mortgage that starts maybe with a 2, and a lot of them with a 3, and 3.25, 2.75, and you say, okay, now when they sell, they're going to be buyers, right? And so they're looking at mortgage rates and saying 5.75, so
same mortgage, half the size.
Double, yeah. My advice is this, and I want everybody to hear this with all the love that I'm intending. People aren't good with percentages, so calculate the number. That's all I'm going to recommend, is calculate the number. Because, you say, oh my gosh, we're going to go from 3.25 to 5.75. We can't afford that. What's the number?
Monthly payment.
What's the monthly payment?
What's your monthly payment? Let's start with the reality of what the payment is, because you may be surprised. You may be surprised how much or how little that might actually be. And so again, I'm going to just go back to, it's a little bit related to the pain factor, right? If you start to look at, well, if I move from a 3.25 to a 5.75 mortgage, it's going to mean, $400, $500, depending upon what you're borrowing, $700 a month. Okay, now the pain that you're experiencing, is that worth it? I mean, you got to be capable, but is it worth the pain that you are experiencing? So all I'm saying is, calculate the number, even though it sounds like, oh my gosh, we're doubling our mortgage rate. Okay, but really, what's the number? Mm-hmm. What is the mortgage payment?
Yep. Occasionally, I will meet some the buyers at open house that have been looking for over 5 or 10 years, and they all regret. So they all regret, like, we could have buy, like, back then.
Sure.
Yeah. So.
Well, there's a saying, the road to heck is paved with regrets, right? And so all I'm saying is this, there are 2 great days to plant a tree, 20 years ago and today.
Yeah.
And so all I'm saying is that we're not going to change what we didn't do or even what we did do. But what we can change is what happens today. So the 2 factors really on the whole affordability index relates to, well, there are actually 3 key factors. The first one is mortgage rates. The second one is household income, because we're looking at the percentage of your household income that's going to be needed to make that mortgage payment. So is your household income going up, down, or staying the same? And then the third is the price, because what you mortgage is affected by what the prices are. So that whole affordability thing really focuses on those 3 factors. And you're right, when we look at the affordability index across the country, right now the Northeast is right in the mid-20s. In other words, it takes about 27% of our household income to cover the principal and interest in the Northeast. In the West, in California, it's over 33%. Mm-hmm. And the last time there was a significant drop was in 2007/8, and the West was in affordability index of about 38%. Wow. Not sustainable. It's just not sustainable. So what I say to people is, if we want to foresee what is coming, always look left. Always look west, which is left on the side of the country. But always look west, because that's where it tends to start or come from. Whether we're talking about affordability index, home prices, the weather, it all starts from the West. And so take a peek at that. And then obviously know what's going on in your area, our area of the Northeast. Now, relative to affordability, yeah, it's definitely changed. I mean, it definitely has changed. Less people are qualified to buy a median-priced home based upon their household income. And so that's why we're starting to see prices starting to chip down. Now, that doesn't mean we still hear the stories, right? Oh, the Smiths went on over at 123 Mockingbird, and they got, $100,000 over asking, or we had multiple bids and so forth. Those things are still going to exist. By the way, there were multiple offers in 2008, right? When we were in the cellar, price-wise, there were still multiple offers because it comes down to value. Can we see the value? Are the homes priced at a level where the value is evident? And even in 2008, people were buying homes. Okay, there might have been short sales, there might have been foreclosures. By the way, in 2008, the affordability index was 11%. In other words, it took 11% of your household income to cover the price. Yeah. So, and now it's in the West, it's 33%. In the East, it's 27%. So when the affordability index is 11%, what do you buy? Everything, because it's only going in one direction.
You just triggered Yuki's regret.
Sorry, Yuki. I didn't mean to bring that up again.
And
That's okay.
and it seems like from my firsthand experience, my mortgage payment has increased over $2,000 a month compared to 2022 and 2023. One of the major factors, of the mortgage payment increase is the insurance, because the insurance company are not making money because with everything's going on around in our country, and so the premium went up, and so it drove the mortgage payment went up. So that also add on, more pressure or burden on home ownerships, as well as I think one of the major factor is I know a lot of builders that they complain that they losing skilled workers like plumber, electricians, and framer, and everybody, because nowadays, the new generations, they're looking to be, successful on social media, and less people are willing to, go into, a professional training to become
Do the real job.
Yeah, to do it like the real hard work. Like people are less interested in real hard work, so we have less workers in construction. So it's harder to build with so much regulations nowadays that put the burdens on builder and slow down the process. So we have shortage of housing, we have shortage of skilled laborers, we have, obviously we before the southern border crisis, that with over 20 million people walked over, we already had 6-7 million housing shortage, and now add on that people. This is that's why there are people, spoke to me and they worried that they can never afford a home, and it just simply doesn't, the income just doesn't catch up.
Yeah. Well, and when we look back again over the course of time, if you were alive or back in the 80s, there was an effort to increase the percentage of home ownership in the country to get it up over 80%.
Oh.
And we know today that it is the percentage of home ownership is in the low 60s, so 62, 63%. So think about moving that number, 17 percentage points for the whole country. And that's when we got into the situation that created the calamity of 2008, we said we're going to make mortgage programs available for folks that might be, might be a little more risky and so forth. And so what happened is people, to get that number up in terms of home ownership level, which, by the way, I believe in. I want everybody to own a home. But the reality is it's not sustainable. If everybody owned a home, what would happen with apartments? And I mean, it's just not reality. My point is this, is that that's when we had those mortgage programs that eventually led to the correction that we experienced in 2008. So we want to make sure that folks who are qualified and so forth do have availability of homes. And the other thing that I see happening, and I know you see it as well, and that is the towns and cities that are savvy enough to make the conversion or allow the conversion of retail that is no longer in use or in use at a very low level and convert that to housing, that is a way to also increase the number of homes. And so we see that happening in a number of communities. And when you start thinking about, those, I'm going to call it those mall spaces that have, oodles of parking, the buildings are, accessible in terms of elevators and escalators and so forth and so on. I mean, it does make a certain degree of sense. And I don't mean convert every mall because there's still, but that's another way of, quote, solving the supply shortage. So, there are some things that are happening that are, I think the view of the critical factors are clearer to us now, to leaders and to us in the industry now, than they were back in the 80s and so forth during other corrections. The other thing that I want to just throw out too, because you mentioned investors, I'm really kind of excited, and I'm going to call it hot about this, is making sure people know that you can own real estate with your retirement funds. Mm-hmm. And a lot of times people find that surprising and so forth. So you can get into being a real estate investor, not only with what I'm going to call your operating funds that you use to live on, but if you're in the position where you're making IRA contributions, Roth or traditional, right, there isn't a way for you to
401k. You can borrow money from that. Mm-hmm.
And so we've done a lot. We have what my wife and I have what we call self-managed rental property, and now we're doing a lot of shift to that, owning it in our 401k, owning it in our Roth IRA, because now the income and the appreciation, if you buy it with Roth funds,
you don't have to pay taxes on that,
no
right?
taxes.
You prepay tax.
Beautiful.
Yep.
Yeah.
So, depending upon where you are on your runway, that's my new word for longevity is, my runway is getting shorter. But where you are on your runway, you don't have to necessarily just be in IRA funds that are stocks, bonds, and so forth. There's a way for you to be in real estate, art, gold. I mean, there's.
That's another form of bonds or stocks.
Yeah, exactly. Okay. So as the market corrects, it may be a good time to access the benefit through IRA funds or retirement funds.
Mm-hmm. So before we wrap this up, with the everything's going on, all the challenges and all the uncertainty now, what else, or do you have any final words for those new agents that looking to join our industry, and also for the home buyer, some encouragement,
sure.
About home ownership? Like, this is an accomplishment that everybody want to achieve in their life.
Sure. I'll start with consumers, with buyers. I guess these words were being used a lot, saying, wait and buy real estate. And I've started to have the attitude of flipping that around and saying, buy real estate and then wait. Real estate overall appreciates. So it really comes down to the timing, right? I mean, we look back, not all of us have had this situation where we say, gosh, if we had only bought, then, or so forth. And so this is the then. Now is the then that you'll be referring to 5, 7, 10 years from now. And so it really, appreciation of real estate is really based upon the length, the term, how long you hold it. And that doesn't mean that there might be some years where there's a dip downward or whatever, but overall, when we look at history, real estate appreciates. So that would be my suggestion to buyers.
I'm really curious to see how much I can afford with that pre-approval letter 20 years ago.
Oh, right. Yeah. And so the other thing is we talked about buyers or consumers, and then also let's talk about agents, people coming into the business. We have left, I think you were talking about agents, some of the things that are out there relative to training and so forth. The great news is we had a 10 to 12 year run of appreciation and so forth in the real estate market. The bad news is we had a 10 to 12 year run in appreciation and so forth in the real estate market because we became an industry that our commodity, our value was speed. And how fast we could do it, how fast the sign went in the ground, how fast we got an open house and, got 5 agreements and a day and a half and we closed in 20 days. That was speed in that market environment. Now we're entering a market of skill. Mm-hmm. So we didn't have a ton of agreements back then where there was a home to sell contingency. Even a home inspection contingency agreement was rare. Those kinds of things. And so now we really have to refine, upgrade, or bring to the forefront the skills that we are going to need to apply to make sure the consumer has a great experience, either side of the transaction. Mm-hmm. So, people are quoting and saying, the industry is losing X percent of the agents and so forth. Yeah. We last year we lost about close to 23% nationally of the agents. And so what that means is, it doesn't mean that real estate's going out of vogue. What it means is the folks that did 1 or 2 transactions that were not really in it, but kind of around it, aren't going to be around it under today's market. And I think that's a good thing for consumers. And that's a good thing for us. We have
the older folks stay.
Well, older or skilled people who have a commitment to it. It's not a, quote, hobby. So I think that there is still, and the other thing I'll just say about the market climate is, this is the best market to enter real estate in as a professional because you're going to have the opportunity to learn those skills. When you came in, right, Yuki, when we came in 5 years ago, I mean, not that you did that, but people who came in 5 years ago, it wasn't required. It wasn't needed to be able to function. So the best time to enter an industry is when it's undergoing a change in the downward direction.
Mm-hmm. Yeah, 5 years ago, the house sell by itself.
Yeah.
Everybody can sell a house. 5 years ago.
Right. I want to add on to that.
Now you should join Alpha Group to learn the skills.
So I want to add on to that. Yeah. So I really think during COVID, when everything sells itself, a lot of people think, all right, this is easy money, quick money, and everybody jump in. Everybody without a lot of extensive training and learning, and then they go on, and then a lot of things probably went bad and went south, and that's why, very easy to get a bad rap, with a lot of buyer agents, and
Sure.
that caused, the image.
Yeah.
It wasn't as quite
No, it's perfect
pretty.
time to add more tools to your toolbox.
Yeah.
Yeah, and to
Exactly.
be more skillful. So.
Yeah.
Cool. Very cool.
And we are the right team for you.
The professional will
Yes.
stand
Yeah,
out.
we're hiring. We're hiring.
Yes.
All right.
The right people.
Yeah,
the right people.
The right people. All right. Thank you, Alan. This
Thank
has
you so
been
much.
My
very
pleasure.
enjoyable. This has been an awesome conversation, and we appreciate your time so much. And you've been phenomenal. You are our coach, and we almost, looking at you also as our life coach as well.
Mentor.
And, yeah, mentor.
thank
and
you,
we
thank you.
appreciate your time.
He-
Really, like
he
to
is, he
spare,
is, yeah.
like to share your lifelong experience and insight with our audience. So we truly appreciate you.
That's priceless.
Thank you.
Really,
All right.
so
Well,
much.
I've enjoyed it, and,
right.
and I'm glad I could.
Yeah, we should do it again soon, okay?
exactly.
All right, appreciate
you.
you, Alan. Thank you.
All right,
All right.
thank you.
Thank you, everybody. We'll see you soon. All right. Thank you. Bye-bye.
Bye.